We're going to finish the sampling overview. And 2, we're going to go back to chapter 3. And I think we'll make some, I sent out some CPA questions that, for this sampling overview. Maybe we'll go over some of those. But let's go ahead and jump into the sampling. Any question on anything? Yeah. Is there anyone that does not have the handouts? The handouts are basically the same as last week, with the exception of the multiple choice questions. What am I doing here? Here we go. All right, so I think we ended up, we finished page 3. I think we stopped right there. So I think we're starting on page 4. Okay. Sampling risk. Sampling risk is the risk that, I should write it out. How about? So sampling risk is a risk that the sample does not reflect the population as a whole. In other words, it's candidate, you have the possibility of getting a sample that does not show really where the population is. So let's say you have something down here, you have this sample, and it looks like it would be 100,000 is your best estimate. Could be a little more, a little less. Well, it's possible that it could be way over here. Or it could be way over here, actually, and you just happen to pick a sample that does not reflect the population as a whole. Okay, so let me see how many I want. Okay, so if your sample is if you get to 95% level of precision, then 5% of the time you're gonna be wrong, and there's nothing you can do about that. The only thing you can do about that is take bigger samples, or even 100% of the sample. But that's one of the things you have to accept for sampling risk, is that the part of the time your sample will be wrong. And they actually kind of beat this one up a little bit in the CPA exam. There's nothing you can do about it. If you're auditing at the 95% level, 1 out of 20 times your sample is not going to reflect the population as a whole. Might as well discuss it here at the same time. We also talk about now non-sampling risk. Oops. Ooh. These come out of errors. So sampling risk is a risk that your sample doesn't match population. Non-sampling risk is basically all the other risks. And a lot of times those are things like errors, that there could be an error in how you apply something, error in judgment, error in whatever it is. That those are risks. Now those are risks that a lot of times can be mitigated through training or oversight or whatever. But the sampling risk you can't really do anything about. So, and just know that when you do sampling, and that there is a possibility. So, what does that mean? Well, what that means is, when you come up with a sample, and maybe it points to something there being a problem with an account, you don't immediately run in and start accusing them of fraud, because it could be that your sample is off, and 1 out of 20 times it's going to be off. So, if you're at the 95%. So, when you do come up with that, what you generally do is take another sample. And, it'd be unusual for you to have two, you have 1 out of 20, and another 1 out of 20 chance. It'd be unusual for 2 of those samples to be off. But so generally speaking, if you do come up with a sample that shows that there is a misstatement, you generally don't get too excited, at least not right away, because there could be other reasons for it. All right. Okay. Allowance for sampling risk. This is something that's called precision. And that is this idea that we have down here of, you guys have seen this before, the bell curve, and every standard deviation, if they have a standard deviation of 5,000, projected value of 100,000, that one standard deviation out will, cover 68%. I'm sure you guys covered this before. 2 out is around 95, and 3 out is 97. Okay, and down here I added this. I should have added it in before I sent it out to you guys, but here's kind of an example on it. And I could send you guys this. So it says the projected audit value above is 100,000. The total book value of the inventory. So this is what the client says the inventory is worth. And we say that there's a tolerable misstatement. We'll accept a misstatement of up to $20,000 for this. So assigned to this account is $20,000. It can be off by $20,000, and we won't make a big deal out of it. Okay, so the question is, do we accept it given this? All right, well, the 95% level, The range is, so the range is, well, let's see, -2, so it'd be 100,000 minus 10,000, so it would be 90,000. And +2 would be 100,000, plus 10 would be 110,000. Okay. So let's take a look at our results. So the book value is $108,000, and we would accept it even if it was -20 or +20. We're going to do the -20 because that's what we're really can't be less than. So what is that? 108,000 minus 20, 88,000. Okay. So here's the thing. We're 95% sure, based on our sample, that the true value is above 90,000. We would accept it if it was even down to 88,000. So will we accept this, the inventory? Again, we're 95% sure, based on our sample, that it's over 90,000.
Hey, Professor.
Yeah.
Is this example new, or is this on the worksheet? Did you add it this week? Because
it's not new. I made it up.
Okay.
I can send it out to you. I mean, yeah, I'll send it out to you guys when I'm done with it.
Okay, thank you.
No problem. But yeah, I should have put it in. I should have put it in. Okay, and the answer to this is, yeah, you'll accept it. Why? Because you'd accept it if it went down to 88,000. It only went down to 90 on your sample. You know, you're 95% sure, 95.4% sure, there's between 90 and 110,000. So you'll accept it because you're 95% sure the rate is 90,000 or above based on your sample. Now, again, you know, remember, we're auditors in that, you know, we say, well, our projected value is 100,000. Should we tell them to write it down? And you're doing the sample to see if they're materially misstated. And if they're not materially misstated, you're fine with it. So should they accept it at the 95% level? Yeah. Let's make that a different color. All right, no. Put green around. Okay. All right, at the 97% level, now look at the 97% level, it goes down to, we have to subtract 15,000 off and add 15. So the range here is 85,000 to 115. Now, notice what happened. We're saying that, you know, we'll accept it if it goes down to 88,000. Well, at 88,000, there still might be 3,000 more at the 95 or 99% level. There's still going to be 3,000. It could actually be even less than that 88,000. So 88,000 is a possibility, and actually at the 95% level, it could even be lower than that. It could be another $3,000 or whatever lower than that. So at the 97% or 99.7% level, no. And so this is kind of how that comes into play, is that, we get a confidence of how, that it's in a certain range. And if it falls, if our maximum amounts that we allow for Pcaob falls outside that range, okay. But if it falls within that range, it's a problem. Because, this range, at the 95% level, this could be as low as 85,000. Which is more than our material amount of 20,000 for the books to be off by. Yeah, so and now it's not to say that you would accept this. You might accept it. If you're at the 95% level, you'd say, yeah, that's fine. You're auditing to this level, which is actually a pretty high level to audit to. You get to that level, you're covering a lot of area. So, but anyway, so this is kind of how it's used and kind of the idea. And I know you guys have been sampling before, but that's the I'll sum this out here with this with the example. But again, this is how you kind of how you evaluate it, and the range that's the range that you are at a certain precision. That's what you think your level of what you believe that the actual amount will be, isn't that? And it's dependent on how sure you want to be. Now that's given the exact same sample. And down here,
Mr. Taylor, I'm a little confused. So wouldn't the 97% be a better percentage to be than 95? Why was it that?
It is a better percentage, but it's also harder to get to.
Oh.
Now, it is possible that you could get to it by taking a bigger sample.
Oh, okay.
I don't know. I can put this, for example, if this was 500 items, it might be that you could definitely tighten that up.
Okay, I understand.
Yeah, it's sort of like this. So let's say that you have a sample looks like this, and this is if you take 500 items. And maybe you kind of don't get the results you want. It's outside of it. You say, okay, I want to be more sure. So you take another sample, and maybe it looks like this. And what will happen is it'll kind of tighten up. That bell curve kind of squeeze in until if you get to 100%, you'll know exactly what it is. But so if you take a bigger sample, let's say 800 items, it'll close that in some. And yeah, now, but for every sample though, you're gonna have the same thing, the standard deviation, at the 68% level, 95, 99, it goes out further and further out. But yeah, given the exact same sample size though, you're gonna have to be more sure, you have to spread that out that, okay, there's, it's likely, or it's possible that we could have some over here and over here. So, yeah.
Okay. Okay, I kind of just said the same thing that we just did up here.
Oh. So for the same sample size, a lower sampling risk will have a higher allowance for sampling. So the lower the sampling risk, we'll have a higher allowance for sampling. So this will go up. The allowance will go up based on how sure you want to be. The more sure you want to be, the larger it's going to be. And that's for any size sample. A larger sample size can reduce the sampling risk and the allowance for sampling risk. That's kind of what I was just talking about. So, to be more sure, you can take a bigger sample. And a lot of times, that's exactly what you'll do. If you come up with a sample that seems like it's pointing to a problem, instead of running and yelling, what you're going to do is take a bigger sample. Be more sure of it. You'll be more sure of your sample. Okay, I'm going to move this down to the next page. Okay, test the controls. We talked a little bit about test controls. These are yes/no tests. I think we talked about that. And test of controls are, you want to get some kind of an idea of how well the controls of the company are working. How effective are the controls? Man, does that look big? Kind of made it. It wasn't really efficient with this handout. Test of controls. I should probably mention here.
Could you share your screen, Professor?
Oh. Yeah. That would be handy.
Thank you.
Apologies. Testing controls. Okay. We already did a test run through this, so I'll just go over it again. Test controls. You're testing how effective are the client's controls. So, can you rely on the controls? Basically, what you're doing. Now, I am going to give you two different rules for this. Aicpa rules. Oops. Aicpa rules. This is for non-issuers. Oops. These are optional. Okay. All right. I don't think I talked about it. Maybe I did. Ascpa rules. These are for non-issuers. They're optional. The tests are only required if you're going to rely on the internal controls. So if you're going to rely on the internal controls, you have to do the testing. But if you're not going to rely on them, and what I mean by relying on them to reduce the probability of material misstatement. If you're not going to rely on them, you don't need to do them. You still have to get an understanding of your internal controls, but you don't have to test them. But if you're going to rely on the controls, you have to test them. So they're optional under the Ascpa rules. And remember, these are for non-issuers. So a lot of times smaller companies don't have the extensive controls that a large company would. If you have to segregate duties, that's really hard to do when you have an office that only has 4 people in it. So a lot of times they don't have as many internal controls, so there's no, there's no reason to test them because they're not really there. So what you can just do is just do a higher level of sampling for the dollar amounts. Instead of testing for the controls, you say, okay, I'm just going to do testing of the dollar amounts, whatever the dollar amounts are. I'll do more of that testing. So it's up to the auditor. It's a judgment call, and they're optional. Pcaob rules, and these are for issuers. They are required. They're required. The external auditors will issue an audit report on the client's internal controls. So because they're going to issue a report on the internal controls, when they're doing the audit, they don't have this option up here of not testing because they're going to make a report on the internal controls. So even though it might not be relevant to the income statement or the balance sheet, it could be very relevant to the report on internal controls because there's 2 reports. You get a report on the financial statements and on the internal controls for an issuer. So because there's a report on internal controls, they must do it. Okay, and kind of down here is sort of what is a control, and we're going to how we go about testing. And by the way, one of the things I got to tell you is that internal controls are one of the hardest things in auditing. And I knew that when I graduated, but going out in business, I can't tell you how many times I would bring up a control problem to somebody who's been working in a company for 30 years. And I'll say, well, here's the control problem. And they'll look at you in the blank face and go, well, what do we do? I don't know. I've been here 8 months. You've been here for 30 years, But I do want to. But it's difficult. These are kind of difficult. It's a lot of logic to it. So if they don't come immediately about the testing of controls, that they're difficult, and they're difficult to know what the right course is sometimes. Even for people, like I say, who've been working in business for 30 years, sometimes they don't deal with it every day, so it's not always obvious. Okay. I'm sorry, I gotta stop sharing this for a second. All right, so for example, so this is a control that if you have a claiming control that 2 managers must have signatures on checks, so requires 2 managers' signatures on checks written for more than $5,000. And by the way, why do you think they do that? So that if the check is for more than $5,000, you got to have 2 people writing, the 2 people signing off on it. Why?
Like it checks on balances, isn't it? So that not one person commits fraud.
Yeah. So that, especially for larger amounts, that there's someone else knows about it. That you don't have just some person doing this thing, this stuff on their own. So you might have this control in there so that at least somebody else will know about it if someone writes is trying to get a large expenditure approved, somebody else knows about it. Okay. So got to take a sample of checks for more than $5,000 and determine whether they had 2 manager signatures. And it's going to be a yes or no. You know, there is no gray area when it comes to testing controls. It's either there or it's not. So, and that goes for missing documents or anything. If they, they say, oh, they must sign off on the purchase order. If there's no purchase order, it's a no. Right. So I mean, they're yes/no tests. And if you can't figure it out, it's a no, usually. Okay. So yeah, go ahead.
Sorry, I just have a quick question about this because I know that a lot of, so with the requiring of 2 checks, I know that's their like internal control, but the two signature, I guess, requirement isn't something that's honored by the bank. So those items can still get paid with just the 1 signature. Yeah.
And sometimes they do have more than 1 signature on a check, but they can also they can actually have check out set up and they'll have more than 1 signature. But you could also think about maybe a better way for me to write this would have been for approval of the checks to be written. You know, you need 2 of them. But yeah, so the idea is you have more than 1. I'll tell you a crazy one. And then it was in our system for getting ordering things that aren't inventory. So ordering desks and ordering machine parts and ordering maintenance parts and all that kind of stuff. We had a special system that did that, and and the system it was an off-the-shelf system, really good system. A lot of companies used it. Pretty big companies, a lot of times they'd use them. You could do all kinds of stuff. Modules for it also. And they had you could have up to 3 approvals on each item, you know, for something to be purchased. That 3 people would have to sign off on. This is the craziest thing. This is Navistar, used to be International Harvester, but Navistar had altered the system so that it required 9. It required 9 signatures to get anything purchased. Do you think that helped the internal controls or hurt them?
I mean, I personally don't believe that would help it. I mean, 9 people.
No, for one thing, it spreads out the responsibility over 9 people, you know, and 2, you would see managers sitting at his and her desk, and they would be simply clicking through dozens of these things because they have nothing to do with them. Approvals for these things, they have no, you know, it was a crazy system. And I wrote it up as an internal control, a problem. There was a significant problem with internal control because nobody knew who purchased anything. No one knew who approved it. No, you know, it was really a kind of they were like, well, it has to be better to have 9 people look at it. But the fact of the matter is, people stopped looking at anything. They were just, and in fact, they would have, you know, some guy off the shop floor even sometimes would come in and, you know, if someone was on vacation, would be sitting there and clicking and approving everything. It was kind of nutty, but I don't think they changed it though. I think they dug in on that one. No, we need to have 9 people. Okay. So anyway, yeah. So, but the idea is, you know, we're really looking at is just are there exceptions to it. So, if they have 2 manager signatures on a check, I think I took this off of the CPA question. To be honest with you, I lifted this one. So it's a yes. These are yes or no tests. Does it have 2 signatures or not? Or in Navistar's case, does it have 9 signatures or not? Where's that nice signature? But okay, so the auditor picks 200 checks for 5,000 or more, and the auditor allows for an error rate of 7%. So as long as the error rate is 7% or less, the auditor's happy. And the allowance for sampling risk is 2%. So we're saying, okay, whatever we come up with for our sample, it could be, same thing as the up here. That sampling risk, you could go, in this case, we go 2% this way or 2% this way. We're really dealing in error percentages rather than dollars, but the idea is exactly the same. So the allowance for sampling risk is 2%. So it could be plus or minus 2%. Okay, so they pull the 200 checks, and this is what they come up with. What's the error rate in the sample? So you pull the 200 checks. Yep. 3%. That's correct. Let me highlight this. Okay, so what's the rate? So we had 6 errors, and that was at a sample of 200 checks. Really don't need this in parentheses, but I'm gonna put it in there just because I like parentheses. So this might be 0.03 or 3%. So this is the error rate. Okay, now, so when the test rule, you got to rely on the control risk for the client, yes or no? Well, they have the error rate is 3%. The allowance for sampling risk is 2%. So now it doesn't say whether this is a 1 or 2 tailed test, but it can be 1 tailed. But this, well, let's assume it's a 2 tailed. So this could be 3% plus or minus 2. We're really going to just worry about the plus 2 on this one. So should they rely on the controls? What do you think? So you get an error rate of 3. Okay, actually, now it's sort of like this. Let me do the camera first before I jump over. So it's sort of like this. So the estimate is that there's 3% error rate, and that the allowance for sampling risk is 2%. So according to the sample, oops, the error rate plus the 2% is 5%. So whatever level they're auditing this at, this would be where they would be at as far as what would be the worst case scenario, that there'd be a 5% error rate. Now, if this was if there's a test like if this is like I showed that has both sides to it, you also have to do a 3% minus 2% equals 1%, but usually you don't worry about that because if the error rate is lower, it's not really, that's a good thing. But this is what we're more worried about, that this going down the scale, that how bad could it be? We're saying it could be up to 5% bad. Okay, so let's go back to so according to our sample, the rate could be up to 5%. We'll allow for an error rate of up to 7%. So would we accept this?
Yes.
Yep. Yeah, you accept it because the upper limit on the errors is I need to get better at using a mouse. The upper limit on the errors is still less than what we would accept for the error. We'll accept it to be up to 7%. The error rate we tested was 3, but it could be 2% worse. So the upper limit of what we would test it would be 5%. It's still less than our 7%, so we would rely on those. And by the way, when I talk about doing the testing, I think I mentioned this. All the sampling has to be, and all the testing you do in auditing has to be repeatable with the same results. So everyone should be able to take those same checks and come up with the same amount. Now, how you interpret that, could vary. And you see that up here, how you interpret it, the judgment could vary. At the 95% level, this was okay. At the 99% level, it's not okay. So, but this is all repeatable. It's just a matter of how you interpret those. There's a lot of, it's all judgment. Okay. Oh, okay, this thing. Oh, this thing's important. Now, unfortunately, I made this into a picture. It really limits what I can do with it on the screen. I'll just have to live with it, I guess. Okay, so here's a table, and you'll see these often in auditing books. We'll go with okay, and basically is over here are the auditors' tests. So their assessment of their internal controls. They either come up the controls are adequate or they're not adequate, or they're inadequate. They're not adequate. So these are the results. Now over here, this is the true actual evaluation of the controls, that they could be actually adequate or inadequate. And the only way you know that by testing 100%. But so this is the auditors, this is kind of like the sample. And then these are the true amounts, and the true amounts are something that unless you do 100%, you're not going to Okay, so I'm going to insert, so if the audit, okay, it's not doing there we go. Okay. So if the auditor thinks it comes up that the controls are adequate, and they really are adequate, that's the correct decision for the controls. You came with the correct answer form based on your sample, most likely. And same thing here. If the auditor came up and said, look, these controls are not adequate, we can't rely on them. And in truth, you could rely on them. That's also okay, right? Because you now know that you can't rely on the controls, so you're going to do something else to figure out those account balances. You can't rely on the controls, so you use something else. So those two are okay. Now these two are the problems. And I'm going to insert, put a square. Okay. Assessing control risk too high. So this is when you do your tests and you come up that we can't rely on these internal controls. But it just so happened maybe you picked a bunch of bad examples, that really don't reflect the population as a whole. Maybe the controls were adequate, but you thought they were inadequate. Well, that's not too much of a problem because you're probably going to do something else. In other words, you're going to do more substantive testing and you'll come out with the correct decision eventually. It'll be an inefficient audit. It'll be an inefficient audit. Efficient. Okay. It was showing red, and I was like, wait a minute, that one shouldn't be red. All right, so it'll be an inefficient audit because you're going to do more work than you really needed to. You could rely on the controls, but your testing said don't rely on them, so you didn't rely on them. So that is an inefficient audit in that you could have done less work had you come up with the right decision over here. Okay, and this one is when you do your testing and you think everything's okay, that it's adequate. And so you say, okay, well, we don't need to do as much testing because the controls are working pretty well. When the reality is they are inadequate. The controls are much worse than you thought they were, or bad enough that you should rely on them. And this will be a guess I should probably put all in there. Okay, which one of these is the worst? The inefficient audit or the ineffective audit?
The ineffective audit.
Yep. Yeah, perfect. That's the one that's the worst. It's because you think everything is okay when it's not, and you don't do the extra testing that you should be doing to make sure. So, this one you generally you do extra testing, but you come out with the correct answer usually. You go to your substantive testing, your dollar testing, and you do more of it, and you're going to say, okay, everything's okay. It'd be kind of unusual to have two different samples come up with the same wrong decision. It's in the possibilities, but it's very rare. But this one is the dangerous one, and this is the one that you get real problems with, and that is because you think everything is okay when it's not. Question on that? Okay, let's go to the time is it? All right. The same thing holds true for substantive procedures, either for the dollar amounts. You recall, I think we talked about this, that substantive procedures, these are where you find, these find material misstatements. These are the ones that actually for the dollars testing. And you just look at the dollars, by the way, for this one. Excuse me. And to make a kind of a point about this, so the substantive procedures, you don't care about the internal control. Well, I don't say you care about them, but you don't rely, the actual amounts that you're getting are just what are the dollar amounts. So going back to this thing with the checks were more than $5,000. Do you just care about what the amount is and was it correctly reflected in the financial statements? Whether it was approved correctly or not, there's no place for that in substantive testing. It doesn't matter whether it was approved correctly or not. What was the dollar amount and was it accounted for correctly? There is no yes or no or anything like that. It's just dollars. Okay. So some of the procedures include, we did these, classical sampling. I don't think I graded them. Did I grade those? I don't think I did. I'll have to look. I'll see if I graded them. If
We typed it in. I don't think you graded it yet.
Yeah, I don't think I did either. I'll take a look at it. The next one we're going to do for dollar amounts is probably proportional size. This can go under a few different names. As we'll put them in because they're all the same. Dollar value sampling, dollar unit sampling, monetary unit sampling, I think on the CPA exam, I think they usually call it dollar value sampling or probably proportional size. They might be sometimes called PBS sampling. That might not be terminology they use nowadays, but a lot of the questions are Okay, and you'll notice that this table that we have here looks very familiar. And,
Hey, Professor, can you go to the perfect to the probability real quick? I didn't get the last part.
this one up here.
No, on on the bottom, the probability proportional to size.
Oh, right. Yeah, these are just kind of the I don't know. The funny thing is that this is like the only kind of pure auditing sampling. So you'd think that there would be a universal term for it. It used to be probably proportional to size, but apparently some people don't like that. So it's a dollar value or dollar unit, monetary unit, dollar unit. I guess monetary means it could be in other.
Thank you.
Yeah. And so this is same thing as of above, correct and correct. And then the problem here is it would have been quicker for me just to make the thing here. I'm gonna drop it here for now and then just there we go. And so these again are the problem ones. When you're coming over here, you think that it's materially misstated when it's not. Well, generally what you do then is take another sample. It would be unusual to have two samples that are both off. It's a possibility, but it's a very, very slim one. So usually, the second sample you take usually says, okay, there's not a problem here. If there's truly not a problem, it's likely if you take a second sample, it's going to say there's not a problem. Here's the really tough one, though. That you think everything is okay, that they're not materially misstated. However, they are materially misstated. So you think everything's okay, but it's not. Okay. So we're talking about the relationship between tested controls and substantive testing. So you do tested controls. Basically, if you want to rely on the controls, and that will hopefully reduce your substantive testing. Okay, so this is a kind of question. Suppose the initial tests indicate that the controls could not be relied upon. So you start doing your testing of internal controls, and you realize that these controls you can't rely on. They're a mess. They're not following them, or they're designed wrong, or whatever it is. So what do? You increase the tested controls or increase the substantive testing?
You increase the substantive procedures.
Absolutely. Oops, did that wrong. Did that wrong. Yeah. If the controls are no good, if you can't rely on them, there's no use in doing them. So when you find the controls are lacking, you can't rely on them, at that point you stop testing. Because the whole reason you're testing them is that you can reduce your substantive procedures. You can reduce the amount of testing you do on the dollar amounts. And if you can't do that, then there's no reason to keep on with it. So the relationship is Inverse. Relationship between substantive test or procedures. I keep it same. An extra space in there? No, I did not. Looks like it. So it's inverse. So the more of one you do, the less it does. And generally, for the most part, a lot of times you don't make that decision. It's made by how, you know, what kind of controls they have. If you have really good controls, you can rely on them, then you reduce the, you know, you do the test of controls or reduce the substantive procedures. If you can't rely on them, you go, okay, forget it, we're not going to do it. You could also not rely on the controls if you, depending on what you're auditing, the accounts, for instance. Let's say that you're auditing contracts. So this client has contracts, and they only have six contracts. Well, instead of looking at all the tests and controls, seeing the procedures of the contracts and the approvals and all that, you just take the 6 contracts and look at them. You know, there's only 6 of them, so go in, dive into the contracts and see if they're being correctly reflected in the financial statements, ignoring the controls over them, because you can't really get around the fact that when you're doing the audit of financial statements, your opinion is on the financial statements. It's on the dollars. So, you know, that's one of the reasons why I have this down here, is that it's on the dollars. So if you can't rely on the controls, say, okay, we got to do more of these to get the same comfort level for the dollars. Question there? Okay. Well, let's go ahead and take a, let's go take a break. Let me pull up something first, though. First of all, let me save this. I'll send this out to you guys if you want to look at it. Here's the, all right. Let's pull up. So I sent out these the sampling overview, multiple choice questions. And we'll go through these, and I'm going to put the poll up too. Where's the poll? It's timing. I'm not sure when the time. I don't think it's timing. But anyway, so as you go through, we'll take a break. We'll come back in like, what time is it? 7:06, maybe 7:15. Come back, be back 7:15, and right down. And we'll start going through these. And on the statistics test, I'll give you guys, depending on how the class does, I'll give you guys extra credit points. You get at least 50%, I'll give you plus 50%. From right, I'll give you plus 2, 75%. It could be, it was only 10, which was 7. Plus 3, and if you get 100%, that 400 is tough. So, and I think these are anonymous, so feel free to enter them. And go ahead and take a break. But if you want to start working on those, you certainly can. Ah. Hello. So go ahead and start filling in that the multiple choice thing. Just again, these are they're anonymous, so don't worry about putting the wrong answer in. Let's see if you can figure out.
We was only able to see down to 4. That's okay.
No, you have them. I send them out to you.
Oh, okay. I didn't have them, and I was trying to look for them. Okay, because I only did 1 through 4 so far.
Okay. Yeah. Let me. I can put it back up. But yeah, they should be in the. They're also in Blackboard under the.
Looked under the course files. I didn't see it.
It should be in there.
Let me see. I was just.
Maybe I didn't put it in there. I thought I did. Oh, I did. What the heck? I didn't put anything in here. What's the deal here? Well, that's odd and not good. Let me apologize. I thought for sure I had. I don't know if I put it in the wrong.
It's the sampling overview questions, right?
Yeah.
Yeah, they're in there.
Okay. Let me see how to. Shoot, I was just.
Try like refreshing or something.
Exit. Full screen.
All the way at the bottom.
Okay. Remove it. So.
Okay. Yeah, they are there. Well, you know what's funny? When you said that though, I pulled it up and it only showed the first 5.
Okay, wait a minute. I see something.
What after we submitted our our answer for that quiz, how do we know how we did?
For this, for the one you turned in?
Yeah, as in 3 minutes ago.
Oh,
You posted that little survey thing.
Yeah. Well, there's some people filling it in.
Oh, okay.
Yeah, so we're gonna let some more people fill it in, and then we'll go through them. But and again, you guys, there's not don't be afraid to put what you think it is in there. First of all, it's anonymous, and second of all,
and it's 10, so I just gotta, like I say, finish it starting at 5. I just printed it out, so give me 1 second.
Oh, okay. I wish there was a better way to put stuff side by side on the screen here. This is I know that I think you're supposed to be able to do it in Zoom as a client, but I've had meetings where I couldn't do it. So I know that I'm not sure what the magic is to having it so that it can always be like that. But yeah, so anyway, this is hopefully we do more of these kind of things like this. And I really think that one of the ways you learn stuff is by going through this kind of stuff, ideally in groups. If this was a class, I don't know how many people are in the class, 15 or so. If I get 3 groups of 5 people and you go through and you discuss them, and really that's kind of I think that's the best way to learn. My opinion is that's the way to learn it the best is when you actually talk about it, because it's your brain, you're talking, you're building all those webs up in your brain. And these questions, they tend to be, I think, a little bit difficult. You got to remember too the way that they write these the way they write these out. Let me give you an example. You get a lot of questions like this. Where you look at the CPA exam. You'll have questions like a red stoplight means. You get answers that are obviously not it. But then sometimes you get answers that are true, but they don't answer the question. So it can be tricky because you're looking for the correct answer. And again, you look at this and you say, well, this is true, but you're looking back at the question. So you actually get quite a few questions that are like that on the exam. So they don't make it easy. Okay, well, most people are going through. Let me pull up the. Okay, looks like most people are in here. Okay, number 1. You guys got that one all correct.
And
Yeah, sampling risk is that the sample doesn't represent the population as a whole. Whatever reason you picked all bad ones or all good ones or whatever it is, it doesn't represent them. Question 2 is, well, they were all over the place. However, the most picked one was B, and that is correct. Three people picked. One person picked A, one person picked C, 2 people picked D, and 3 of you picked B. So B is actually it. So attribute sampling is sort of like the yes/no. This is the test of controls. And you have a deviation rate. Three, I don't think we talked about. The tolerable deviation rate for testing controls is generally lower than the expected, higher, identical, unrelated. It's generally, and again, this is one that you guys pulled out. It's actually going to be higher. And here's why. If the amount you would tolerate, if you expect more errors than you're willing to tolerate, you probably wouldn't do the test of controls. So usually you're going to have an expected rate that is lower than the tolerable rate, and then you're going to have some sampling risk, plus or minus, but usually plus some amount, 2%, 3%, or whatever it is. So the tolerable rate, in other words, the most that you will take is higher than the expected. If you expect the rate is worse than the tolerable rate, probably not going to rely on them. Oh man, look at the wacky spacing on that one.
That's not fair. It's just me.
No, that's okay. Number 4, the risk of incorrect acceptance relates to the A, and that's what you guys picked. These are 4 for 4. Yeah, the effect. No, yeah. So the incorrect. If you talk about something is incorrect, you're really looking at these two. The efficiency and the effectiveness. Incorrect acceptance means that you accept it, however, you shouldn't have, and so that's going to make an ineffective audit. So you accept whatever they have for the for account, but you shouldn't have. So you have an ineffective audit. And that's the scariest one, because you think everything's okay, but it's not. The likelihood of assessing control risk too high is a risk that the sample selected to the test of controls So, well, first let's go to the assessing control risk too high. This means you think that things are worse than they really are. You want risk to be low. So if you assess the risk and you assess it too high, what does that mean? Okay, you guys picked A and B. Now, Morty picked A. If I picked A, and this was the correct answer. Now, some of you picked B. And this one, these are kind of things you can look at to just to know, something to make things a little bit easier. And that is, when we do test of controls, we're generally not looking for misstatements. So, well, if you translate this into deviation rates or something like that, then yeah, it's a possibility. But for the most part, when you see these kind of mixed ones where they have misstatements are going to be substantive testing. So this is test of control. So this is going to be maybe different things here. But now this is correct. It's when they the test that they does not support the plan assessed level of control risk. When the true operating effectiveness of controls justifies such an assessment. So we don't know the true rate. You know, maybe the true rate was 3% and we thought it was 6% or something like that. We rejected it, but we could have, you know, something the culture control was too high is we didn't rely on the controls when we could have. Okay, for which of the following tests? I don't know if there's some way that I can, at the end pulling. Oh, share results. That's what I should do. Here, I'm sorry, you guys. I'm completely new to this. So I'll go ahead and share the results. Hopefully you guys can see those. And we're on question 6. Which of the following tests, audit tests, would the auditor likely use attribute sampling? So attributes means that you're looking for usually test of controls. You know, is there approval for this? Yes or no? Was this you know, matched up with a manager or whatever? Yes or no? All this kind of stuff. Okay, so attribute sampling is going to be for test of controls. Let me put that in there. That's a dollar amount. Valuation, dollar amount. Yeah, D. What do you guys pick? You guys pick D, see? Well, you guys are 6 for 6 so far. You're 7 for 7 so far. I guess I don't need to talk about that one since everybody got that one right. Okay, in addition to the frequency of deviations test of controls, the auditor should also consider certain qualitative aspects of the deviation. Most likely would give a broader consideration to implications if it was the only deviation in the sample, identical deviations discovered in prior audits, years audits. It could be a control issue there. You may want to look into that. Caused by employee oversight. Oh, D. Yep, hey, you guys got it, D. Yeah, whenever you run into a fraud and someone tried to conceal it, that's bad news. Because now you have people that are actively trying to hide stuff from you. So yeah, D is whenever there's any kind of fraud that makes things that may not be material more material, and certainly for test controls that you want, you're going to rely on them to have someone actively trying to conceal a problem is bad. It could be they forged names or something like that. The underlying feature of a random-based selection of items is that each let's see. A is each stratum in the population be given equal representation in the sample. That's not true. For instance, the higher dollar amount ones, you want to give more representation to those because they're more material. Items be randomly ordered? No, in fact, you hope they're not randomly ordered. You got to pick a sample. figuring if they're randomly ordered, you got a real problem. Let's see. And I think that, you know, you could read that as saying that they were randomly selected. Now, randomly selected that you do want. Okay, items in the population should, yeah, that's it. And systematically selected, that's not random. And using replacement is, you don't do that. You don't pick accounts receivable and then put it back in there and pick the same accounts receivable again. There are certain kind of samplings where that's done, but we don't do that in auditing. 10. Auditor examines 20 checks as prescribed. One of the checkers shows a sample 20 cannot be found. The auditor should consider this limitation. And oh yeah, this is actually the one I was kind of talking about before. Yeah, you guys got this. If you cannot find the check, so let's say, man, I don't know if you guys can hear that. That's my crazy dog running back and forth upstairs. It sounds like a horse race or something. Anyway, if you can't find the check, you treat that as a deviation. That, you know, the signature's there, it's not. If there's no check, then there's no signature. It's a deviation. So if you cannot locate a document and you're doing test of controls, it's a deviation. Well, you guys got all 4 of those, all 4 of the points. Pretty amazing. CPA questions, if you get, you know, if you get 75% of them, you pass. So getting 100% is, it's ideal. All right. Well, good. Good. Yeah, it's always good to kind of take a look at those. All right, I'm going to close this, I think.
Number 9 was tricky with that word ordered and not selected, because that's exactly what I was thinking.
Yeah, no, it is. It is. Randomly selected, yeah, if this was randomly, I was probably randomly selected, yes.
Right.
Yep.
It got me.
Yeah. And yeah, that one's kind of a tricky. I'm not positive that one was a CPA. It could have been a CPA question, but yeah, they're very specific in their wording in that, and it's sometimes I think it's fair, sometimes I think it's unfair, but you know, it's, you can't argue with them. Sometimes I was students say, well, can you argue with the results on the, you know, I give them CPA questions. Yeah, well, it doesn't matter what I think. You know, when you take the exam, you put down there what they think. You know, that's how you pass it. So okay, yeah, that's pretty good though. That was good. Okay, I'm gonna stop sharing the results. Okay. All right. Well, I think what we'll do, we got a little bit of time. Let's punch through a little bit of chapter 3. We won't go too far into it, obviously, but we'll go into chapter 3. Save this. Oops. All right, so the chapter 3, oops, I gotta pull it up first. I can't remember how far we got into it. Okay, I think we stopped after, do we do the engagement letter?
No, we didn't start that.
I think the last thing we did was the beginning inventory where we highlighted that, and then that was it.
Okay. All right, yeah, and the client continuance, again, the whole point of this one is that your management integrity is what you really want to focus on as far as taking on a client. But client continuance is another thing that every year you're supposed to reevaluate whether you should take a client or not. And I actually had a friend who was working on an audit where they had, it was for a bank, and they actually had the president of the bank. I mean, it was just a squirrel. It was a family run, you know, a little bit bigger bank, but it was mostly family. A lot of family members anyway in the banking thing. And they asked him, are there any family members employed by the bank? He said, no. Well, you look at the list of employees, and 25% of them have the same last name. And so they had to go through and, ask them on each person, is this person related to you? Yeah. Who is it? It's my brother. Well, is this person related to you? Yeah. Who is it? That's my niece. They literally went through and then they pulled out like 30 people that were family members. And then the whole audit was like that. They would ask him, are there any, whatever it is, what about this, what about that? And he would just make up stuff. And he didn't want you talking to anyone else. And so they decided, look, this is kind of ridiculous. We're not going to do this audit again. Now, you generally can't leave an audit right in the middle. I don't know if I talked to you too much about that, but because you're a professional, you're CPA, and so you can't leave an audit right in the middle of it because the client would be in a worse situation, and you have responsibility to your client not to leave them. Okay. Engagement letter. Engagement letter is sort of like a it's like a unilateral contract. And that it's an agreement that if you do X, which is usually perform the audit, that we will pay you X amount of money, but it's contingent on, the bulk of it is contingent on completing the audit, and then, they will give you the money for it. It's the onus is on one party generally. Different than say like buying a car. Buying a car is a bilateral contract. And I give you the cash, you give me the car. That's the contract. Whereas this is one-sided. The auditors have to do the job. So the engagement letter is sort of like a contract, and the actual rules are that you don't have to have an engagement letter, although I think they've even changed that to the ACCT330, but that it is a highly, for the legal standpoint and everything else, it's highly recommendable to have an engagement letter. The engagement letter is basically you laying out what's going to happen with the audit, what an audit is, and all that kind of stuff. So things you'd normally see in it: service be performed, audit, audit responsibility under GAS, that we follow the generally accepted auditing standards. And one of the big ones you always want to put in there would be the limitations on it. It's amazing how many people think that auditors find all the fraud. When it comes to employee fraud and things like that, auditors almost never find it. I mean, they find big stuff like financial statement fraud, but little stuff, they never find it. But people will think, oh, everything's okay. There's no, there's no fraud in this company because the auditor signed off on this audit report. Where, the auditor's not looking for it. So one of the things you have to tell them is, look, we only look for things that are material, and we do not look for things that aren't. So, if it's not material, we don't look for it. Reasonable assurance. Inherent limitations of internal controls. We're probably going to cover that in the internal control chapter. That's a little bit tricky. And that is that even if you have perfectly designed internal controls, you can still have problems. One of the things that you also put in there is management's responsibility. One of the responsibilities are for the financial statements, the internal controls. You say, are you guys responsible for the financial statements? We're not. You're responsible for the internal controls. We're not. And then also you have to provide the auditors with the necessary information. And so, whenever they don't provide you with necessary information, there's a problem. Okay, I think I already talked about this to you guys, didn't I? Maybe I did. Document retention. The AICPA requires that you keep your work papers for 5 years. I think we talked about that, didn't we?
Yeah, we did.
Okay. So what I'm trying to say, you're going to keep for 5 years and PCAOB for 7 years. Financial statement agreement with other documents. One of the problems that you can have is you do an audit, it's on the financial statements. Okay, and the company usually has the financial statements inside the audit, company annual report. And so this usually includes the financial statements. And your audit report. Excuse me. So here's the thing. The question is, well, what do you do if you audit their financial statements and you find out that they have revenues of, I'm speaking of a number, $880 million in revenue. You look at the company's annual report and they say that their revenue was $960 million. So what happens if they put something in the annual report that doesn't match the financial statements? You audit the financial statements. The financial statements say 880 million, but right there in the annual report, they say that their revenues were 960 million or whatever you said. What do you do? So one of the things you put right in there is that the financial statement agreement with other documents. In other words, you cannot put these financial statements with other documents that don't match the financial statements. And down here is kind of the timetable, the fees, specialists, limitations of liability. That's usually limitations of liability if management is lying to you, that you're limited to your part of the audit basically, and the management would be to the financial statements, the liabilities. In other words, you would not be held accountable for the liability of management. Those are somewhat controversial. Sometimes you can't do them. There are some places that some states that won't allow it. Okay. We'll get through this. Page 4. This is a long one, so if we can knock out a little bit here and there, it'll be good. Okay, the audit plan. So this is kind of how we plan out the audit. And one of the big things we do is we assess risks. And, how do you come up with things that could go wrong? What we're really talking about here is things that could go wrong. you know, materiality, but not just dollar amount of materiality, but like we talked about, well, you talk about in the multiple choice question. If you run into fraud, that sort of thing. So assessing the risks are really looking at things that could go wrong and how bad could they be. Oh, excuse me, I just bored myself. Okay. In local procedures, we talked about this. This is there are plausible relationships between numbers. Usually between data, maybe a better way to put it. So, for instance, if sales go up, what would you expect would happen to cost of goods sold? You expect that to go up too. If they sold more things, that the cost of goods sold would go up. More things were sold. So you look for plausible relationships, and if those plausible relationships aren't there, it could be a problem. So analytical procedures will kind of point you to where you need to look, or to some extent where you need to look. Whenever you talk about risks, there's always two different things. We have the dollar amount and the probability. So, for instance, let's do some. Let's say that we have a risk A. So risk A has a dollar amount risk of $8,000 and a probability of 30%. Yeah. Risk B has $100,000 risk and a 2% chance of happening. Which one of those are you more concerned about? Risk A or risk B?
Risk A.
Yeah, if you multiply them, the actual, so 8,000 times 30%, I think it's 2,400, isn't it? I'm gonna check my math. Yeah. You guys ever had me in regular accounting class? I'm gonna check my math. All right, so it'll be 2,400. It's close. Oops. 2% would probably be
2,000.
Yeah. No, actually for this one, these are probably close enough that you would probably flip a coin. But generally speaking, A, it's a larger amount, and it's also, I shouldn't say A, for one thing, it's a larger dollar amount of risk, and secondly, it's more likely to happen. So it's more likely to happen, and it's a larger dollar amount. So A would probably be the one, although this is pretty close. I should have made a more distinct example here, but the idea is the same though, that there's always that dollar amount and probability. So the risk isn't just the dollar amount, it's the probability that's going to happen also. And whenever you deal with risk, you're dealing with those two things. And there are some things that are, really, well, one thing we're living through right now is this coronavirus. I mean, the dollar impact on this is massive, but no one knew about it. No one, the probability was zero basically, it never happened before. It never happened before that you had this, this deadly disease or virus or whatever. So, that's one of those risks that is, even though it's there, you underestimate it because it's never happened before. Now we know that it can happen, the probability is higher. And so even when we do get over this, it could happen again. So yeah, this isn't perfect, but generally you do this to make sure that you are looking at those things that are likely, the things that are the largest dollar amounts and that are more likely to happen. Okay, staffing. And we'll push through this real quick. Necessity for a specialist. Specialist could be, I'll tell you the most used specialist you're going to have is that you're going to have people that do work on, say, things like pensions. They're actually actuaries, and they do work on pensions, in healthcare. Those are probably the two. Those are probably the areas that are most commonly used. Specialists are actuaries. Any company that has healthcare and a pension plan of some sort, a lot of times will have those. There are some other ones too. If you're auditing a jewelry store, you may get a gemologist. You'll see that come up as a specialist all the time. And I don't know how often jewelry stores get audited, but the gemologist thing comes up a lot. IT people, whenever you do an audit, a lot of times if you're working side by side with IT people, obviously a lot of stuff is computerized nowadays. And IT people will know some of the controls, but not all of them. And a lot of the things that you look for as an auditor are not necessarily the things that they look for. So even though they do look at controls, a lot of times they might be a little bit different than the stuff that you're looking at. Use of internal auditors. This is what I was for a while. Internal auditors are people that do auditing inside the company. And the internal auditors are generally the people that know the most about the company. And that, and not because of anything magical about internal auditors, but that, when I was an internal auditor, we went all over, we looked at every operation and so forth. Any given person in their own operation would know more than we did. But as far as having the overall view of the company, no one knew more than the internal auditors. They went around and looked at everything in a little detail to write up the audit reports. So the internal auditors actually are generally the people that know the most about the company as a whole, and they will also have done a lot of audit work, but usually on those areas. The external auditors come in, they might be in for, in the office for 3 weeks. And, they got to do all the inventory, and all that kind of stuff in 3 weeks. Whereas the internal auditors may have spent months going through the inventory. So it would make sense that if you could use those internal audit reports and some of the details and talk to people who actually worked on it, that you might want to do that, because that could save you a ton of time. And that if the reports are if you trust in them, that they could definitely point you in any direction of any problems, or conversely things you don't need to look at as much because they've already looked at them and there's not as much problem there. So use of internal auditors, and these are kind of the the cornerstones of what you are looking for. Are they objective? Are they people that actually look at the things and write up the problems as they see them and that sort of thing? Are they competent? Do they know what they're doing? And do they have a quality control aspect to it? And the objectivity and competence, these are usually the things you would look at more closely. Yeah, being an internal auditor, I actually went to meetings with other internal auditors, and I do remember that there was this internal audit group that we were at one of the meetings, and they basically were almost like a, oh, I don't know, like a management cheerleading group that came around to all these different businesses or different locations and kind of put on a horse and pony show about, you know, how to run the places. And, you know, they weren't objective. I'll put it that way. You know, whatever the management wanted them to do, that's what they did. And they went, you know, and they would have these displays and talk to all the people and, you know, and get them all. They really weren't auditors, you know, not the way you would normally think of them. So anyway, sometimes internal auditors are not exactly it, but as long as they're objective and they're competent, you know, usually okay, I'm not confident in using that word, but as long as there's those two things, you're usually okay. These two are probably the most important ones. And the quality control one is, do they actually, is someone actually review their work and that sort of thing? Do they actually look back? Time budget. Interim audit work. Sometimes you can do audit work throughout the year, and that really saves time at the end of the year. The end of the year is, you know, things are nutty. They're just nutty because you have all these different companies that usually have year ends on December 31st or January 31st. Some of the retail places will have January 31st. And you have to do just a ton of work in that small area. So a lot of times you say, okay, let's spread it out over the year. And if you think about it, let's say you're auditing sales for a company. There's nothing wrong with auditing the sales up through, say, October, right? I mean, those are already on the books. So you could do the auditing of January through October. And then when the actual audit comes out at year end, then you're just going to do November, December. You know, so a lot of times you'll try to spread the work out. Those things that you can spread out, sometimes you'll do that to spread out the work. And that helps both the client, and because there's not so much going on at year end, and it helps you with your budgeting of people and so forth to do things. So a lot of times, if you can get the you have to do it throughout the year, you'll actually have them do that. Stuff at the year end. Year-end work is usually, it's better information. So if you do have a problem doing the interim work, you do some of the interim work and there's a problem with, say, the sales. You know, you're going through the audit January through October and you find there's a problem with the sales. You might just stop and say, look, we're going to do this at year end, because the controls are bad and we don't know what's going on. So year-end work is better. It's more relevant information. You got the whole year, you know, in front of you. So if you do run into a problem with the interim work, then you can do it at year-end, and this could be more expensive and more difficult as far as the audit is concerned. But again, if you need to get better information, sometimes you just have to push it to year-end. Excuse me. Okay, we'll stop there.